Welcome back to Mutual Fund Corner. Still have with us Sandeep Bagla. We are talking all about debt funds, this action from the RBI, what the impact could be, and a lot more about other categories as well. Mr. Bagla, in the last week of March, we saw corporate bond and target maturity funds draw in the biggest amount of money. Corporate bonds alone got over 7,700 crore rupees in terms of an inflow. What are your thoughts on both of these categories?
Okay, so target maturity funds are passive funds, and they help you in sort of cash flow management, in the sense that if you have a requirement for a certain period where you want your money back and you want to keep it away, you could either put it in FDs, or you could buy a bond, or you could put it in target maturity fund. Now, why target maturity funds became popular was because they were investing in, let's say, government securities, and you were getting the tax benefit. As opposed to if you were buying the same government bond directly in your demat account, you would not get the tax benefit. So I think their attractiveness of the target maturity funds is somewhat reduced. Corporate bond funds, on the other hand, have 80% exposure to the corporate bonds which have rating of very high quality, AA plus or above. So it's AA plus or AAA. And they are open-ended funds. So there's no restriction on either the maturity or on the type of duration calls that the fund manager can take. The risk is low in the sense that quality of the corporate portfolio is very high, and it can really give you a good flavor of the interest rate movements and benefit from capital gains from time to time. So if one stays invested in corporate bond funds, I think it will be a very good outcome in the future going forward. So the two are quite different, and I think the corporate bond funds are superior at this point of time.
Okay, corporate bond funds over the target maturity category. Mr. Bagla, what other categories would you look at? Because, as soon as this tax amendment came through and that entire indexation benefit was taken away, we were talking about alternatives. A lot of people suggested, balanced advantage funds, hybrid funds. Do you think these are good options as well now?
No, they are good options. But when I last checked, I think that the expense ratios were slightly higher than if you were to replicate the same funds by investing in a debt fund separately and investing in an equity fund separately. So, for example, let's say you have a balanced fund where 65% is in equities and 35% is in debt. So you are getting equity benefit, taxation benefit. However, if you put 65% direct equities and 35% in debt, probably your overall cost will be better. So hybrid funds have done well over a period, but I feel that there's some room for improvement in fund management or performance, given the dynamic nature of the markets and the various combinations of hybrid funds.
So, when we are talking about income funds, equity funds, and the larger issue still remains that there is no instrument available to a retail investor now that can really help you beat rising inflation with an indexation benefit that has been taken away from debt funds right now. Can you talk to us about any fund, any suggestion you can think of to put in place which would help long-term savings for investors?
So, most investors actually invest for the returns. Tax is an added element which can help you decide whether this instrument or that. So I think, just like I was explaining in the previous half of the show, that the Crystal Composite Bond Index has given a return of between 8.5 to 8.75. Now, if you were to look at the long-term inflation, CPI inflation trajectory in India, I think we would be close to, anywhere between 5 to 6%. And even after taking expenses out, if investors were to make somewhere close to 8% from open-ended pure debt fund, which has a maturity of, let's say, anywhere between 5 to 7 years, and you hold it for 2 to 3 years, I think over interest rate cycles, while your returns could fluctuate, but overall you would be able to beat inflation comfortably. at least historically for the last 10-15 years, that has been the experience. And I don't see any reason why in the future, unless we face a period of extreme financial repression where interest rates are forced to be down for some period, which below inflation, where everybody suffers. But I think those days are over, and those kind of strategies have their own problems. So I think being in an income fund, or let's say a long duration fund or a corporate bond fund or a short-term fund, banking PSU fund, or any combination of these funds would be extremely good in terms of beating inflation comfortably. Whatever liquidity requirements one may have, one could invest in something like liquid funds or money market funds. There's a plethora of funds which have maturity of up to 1 year, and their duration risk and interest rate risk is very, very low. So for liquidity management, you could use funds up to 1 year, and for beating inflation, you should have a range of funds which I mentioned earlier, and with the advice of a mutual fund distributor, you could form a very, very clean portfolio, which will give you returns as well as safety, as well as extremely good liquidity.
Yeah. All right, Mr. Bagla, you've given us a full set of different options that we can look at, as well as a lot of these categories, and taken us through, what will really work for what kind of investors. So thank you very much for joining us and taking us through this in-depth class on looking at debt investing. But we will wind down on that note. Thank you all for tuning in. There's lots more coming up on the other side.